Good morning, everyone. On behalf of the National Restaurant Association's research group, it's a pleasure to have a few minutes today to talk with you about the current state of the restaurant industry, and most importantly, where we see it going the remainder of this year and into next year. My presentation, as currently constructed, has three distinct components. First, we'll look at the overall national state economic environment, and then proceed to examining how the restaurant industry performance has occurred and will occur against that backdrop, and then finally have a wrap-up. But before I start, it's important to reiterate the association's definition of what actually constitutes the restaurant industry, and that is all meals, snacks, alcohol prepared away from home, including all takeout meals and beverages. And it is the latter part of that statement which we refer to as the off-premises market, which includes takeout, delivery, drive-through, and curbside. That off-premises component obviously became a lifeline during the pandemic. And even before the pandemic, for example, if you looked at all restaurant industry traffic in America, over 60% even then was off-premises. During the depths of the pandemic, that exceeded 90%. It's currently in the low 80% range, and it will be an important driver going forward, obviously. So understanding that off-premises market and what drives it is extremely important. So it goes without saying that last year was the worst year in our nation's economic history since 1946, actually, 75 years ago. You can see that drop. This just looks at GDP. This is the dollar value of all goods and services in the national economy. And it's adjusted for inflation, but obviously right there you can see the great retrenchment and then the build out. This year we're looking for close to 7%. A very high number, but it's important to keep in mind just mathematically the numbers going up are higher than the numbers going down. So for example, if you're 100, you drop to 75, that's a 25% decline. To go back up to 100, it's a 33% increase. So you have to get much higher numbers on the rebound just mathematically, and that's considering the same environment. So in many ways, the pandemic was a service sector recession. And if you look at national employment, obviously there's that large plunge last April, almost 21 million. And then there was, in essence, a second recession, and then the gradual build out. But national economy is still down almost 7 million jobs. Why does that matter? It matters because when people are employed, they have more money to spend at restaurants, and they also have less time for at-home preparation. So a good indicator of where the industry is heading is what goes on with employment at both the national and state basis. It's also important to understand the real dichotomy which occurred over the past decade of employment growth in city centers versus in more suburban and rural areas. So if you look at these two, you can see that employment growth over the past decade was almost double what it was in more suburban and rural areas. And what did the pandemic do? It dramatically reversed that trend. There was an outward migration of individuals from these city center areas to the more suburban rural areas. And many restaurant operators have followed that migration trend. And one of the most important things going forward is what happens with that remigration pattern and how quickly and where does it occur. Because even if the hybrid work model becomes part of the national employment infrastructure, you think of these concepts in these city center areas which were built on office workers having 5 days in that physical site. So there is some remigration occurring. It will occur differently in different states, regions, metropolitan areas. But going forward, this is very important because in the end, employment growth and population growth are the most important drivers of restaurant industry sales because it drives income growth. Also, one of the more important demographic characteristics since the turn of the century has been the increased female labor force participation rates. And that was a very important driver of convenience for the industry, because once again, when you have a household where the individuals are employed, they have less time for at-home meal preparation. And so you can see the female participation rate dropped dramatically and then is starting to move up. But you'll notice where it is, it's basically back 20 plus years. Consumer confidence follows closely. It varies dramatically by different geographic regions. Consumer confidence, for all intents and purposes, is basically a referendum on how easy it is to get a job. So you can see that has built up since the pandemic lows there. But more importantly, it varies widely by different geographic regions. So currently, if you look at consumer confidence by region, the Mountain and South Atlantic states have the highest levels, and the East, North, and East, South Central have the lowest levels. And so, for example, East, South Central would be Alabama, Mississippi, Tennessee, Kentucky. So getting to the issue of income, we tend to look at inflation-adjusted disposable, just means after taxes. And you notice here in the first quarter that very high number of income growth. And obviously that was a result of the stimulus packages. That number basically reflects the culmination of 6 federal programs plus the actions that the Fed took. And the important thing to keep in mind going forward is, as with the migration, what happens with that income growth. Because looking at income, it's expected to moderate, and already the absence of additional stimulus is moderating the growth out of this great pandemic. And where do consumers spend? This is also important to understand, because 10, 20 years ago when we were talking to restaurant operators, competition was focused on other operators in basically a trading area. But now the competition is for other necessary expenditures the consumer has. So last year, if you look at all food spending, and that's grocery store spending plus restaurant spending, just 12% of total spend. Half, you'll notice, is accounted for housing and transportation. And we're going to talk about both of those costs are going up individually, so it puts pressure. So not only is there competition within the industry now, but there's competition to get that dollar into food service. And that's why it's always so important to remain top of mind in the local trading areas. Looking at gasoline prices, since 2014, first time $3 more per gallon. The reason we focus on this as well as diesel costs, because diesel is more important to the supply chain, is it does impact consumers' cash on hand position. And so consequently, these higher gasoline prices put a pressure on that 12% spend category going forward. Also, a very systemic issue, particularly for younger restaurant patrons and our younger work staffs, is what's going on with the student debt situation. So if you look at, this is the allocation of debt currently. The orange is mortgage debt, that's the first greatest total. But now the second largest amount in the red is student loan debt. And what that does, it's like a mortgage to many of these households. It puts a month fixed expense against their ability to spend elsewhere. And so it is, like gasoline prices, something else that is watched by the industry because it is a component and impacts how industry growth can proceed. In terms of tourism and travel, this just gives you the TSA screenings, and you can see we're approaching the post-pandemic high. Restaurant industry looks at tourism and travel very critically, because 1 out of every $4 spent in a restaurant is actually travel and tourism related. So consequently, we look at 3 different types of travel and tourism. There's leisure travel, business travel, and international visitation. And as you know, leisure travel is coming back. But for certain operators in certain communities, it is that business travel and even more importantly, that international visitation, which is important to their ability to rebound. And looking at international visitation to this country is extremely important because these are very high spending individuals for the restaurant community. Their patronage is concentrated in certain metropolitan areas. But the fact is, if you look at international visitation, the projections now for the United States to get back to the level where it was pre-pandemic is easily 2023 or 2024. So that's an important point in mind if one's operation has been dependent upon that international visitation. Looking at tourism spending in restaurants, you'll notice the blue bars here basically document the percent of sales that came from travelers and visitors. Obviously, fine dining has the highest proportion, 40%, but you notice the other table service sectors are higher than quick service. And so the yellow bars just basically tell you where it was in the second half of last year. So there's a dramatic decrease, but the leisure travel is assisting certain of the operator communities. Now, focusing at the industry overall, last year the association had forecasts that total industry sales would approach $900 billion. The actual was 659, in other words, over a $240 billion gap. It's quite sizable. Looking at this year, we're anticipating at least a double-digit rebound, but you'll notice that there's still a ways to go to recoup that large gap which still exists. One way to look at restaurant industry spend is look at it as a part of total food spending in America. And pre-pandemic, the restaurant community actually captured the majority of spending on food in America, 51%. It's currently now back up at 50%. And so that is a good development, but a lot of this is occurring through menu price inflation, and traffic for the industry overall still remains below pre-COVID levels. So it's always, as you know, as an operator, important to have the spend to the traffic matrix to understand how menu price increases can actually dampen traffic. But going forward, there's no reason to doubt that as the pandemic continues to ebb, more on-sites open up, and the vaccines take even greater hold, that ratio will again exceed the retail component. So there's the big gap there in at least $300 billion. And this is an inflation adjusted. So you see, normally that line would have kept going up there. So it is an improvement situation. But the fact is 2021 remains a year of transition for the industry. And just looking at monthly, this is eating and drinking places, about 70% of the industry. So pre-COVID, the bottom there, that's over a 50% decline, April 2020. The gradual build out, the second restaurant recession, and then in May, finally the monthly total exceeded. But keep in mind that when you take into the effects of inflation, it's still down in real terms. The association also produces what we call the Restaurant Performance Index, where we survey hundreds of restaurant operators a month, have been doing it for 20 years now. And you can see that mathematically the index is at a record high. The reason for that is going against the lower comps of the COVID. In terms of our weekly tracking studies, we do it for both on and off premises by the different day parts. And you can see that on premises pre-COVID for dinner, we're now only about 5 percentage points below where we were. So that trend line, even though second recessionary period for the industry there, then the gradual build out. And you notice the same is true for lunch as well as breakfast. So overall, the trend is correct, but once again, for the on-premises, there's still room to recover. For off-premises, which was the most important driver of restaurant industry sales basically for several years now, because it is a convenience-driven market, you'll notice that it is appearing sticky. In other words, if you look at the dinner off premises, it still remains elevated, lunch the same, and breakfast the same. So if there's one thing the pandemic did for the typical American restaurant patron, is that it made them much more comfortable and knowledgeable about how to do digital and online ordering. And we're going to talk about that in a minute. The pent-up demand for restaurant usage still remains elevated. So if you go back here pre-COVID, roughly 45% of Americans reported they weren't using restaurants as much as they liked. The depths of the pandemic, 83% for on-site, then the gradual as more sites reopened. But it still remains elevated at 50% for table service, where the yellow bars are the off-premises market, and you'll know the unfulfilled demand there is actually lower because a lot of that traffic and spend had shifted operationally to that off-premises market during the pandemic. So from the association perspective, when we survey restaurant operators every month and we ask them what their top challenges are, not surprisingly, recruitment and retention of labor. 3 out of 4 operators report that's currently their top challenge. That is a high for this series of questions. And notice what's rapidly come up second is food cost. And so it really is a double whammy of having recruitment issues with labor costs moving up rapidly to attempt to fill the labor voids in tandem with escalating wholesale food cost inflation. So in terms of restaurant employment, the industry is still down 1.3 million jobs. That's roughly 10, 12%. You can see employment growth rebound, then the gradual slowing down, the second recession, and then the gradual build out. But at this point, you notice those numbers are roughly just under 200,000 a month net growth. It really means that it is early 2022 before industry employment actually can get back to those levels at its earliest. Different segments obviously have different recruitment challenges. The largest loss was in the full service sector here. You can see it's over 3.5 million. They've basically regained and are still down 500,000. Quick service still down at least 100,000. So the pandemic did drive home the point, particularly of those operating with drive-throughs and already off-premises services that were set up. It did prove to be a facilitating factor. Obviously, all states are not created equal in terms of employment markets nor restaurant spend. If you look at the color coding here, the states in red still are down by at least 20%. If you look at the green states, last month's data came out in Montana and Wyoming here, and North Dakota are now back in the green. But Texas is better positioned compared to other states in terms of the employment loss. In terms of recruitment and retention, it's not just restaurants that have this challenge. Obviously, it's the lodging industry as well. And so hospitality job openings were up 90% just between January and May of this year. You can see that's a very high point in the history of that index. And obviously what the operators do when they can't get the labor they need is that they will increase the hours and wages of those that remain at that operation. And so notice how the number of weekly hours for the industry has jumped up to almost 26.5 now. Also, too, keeping an eye on what is going on with menu price inflation is important because we know consumers are extremely sensitive to increases in restaurant menu prices. The blue bars here are menu price increases and the yellow bars are grocery store. So obviously menu price inflation now is running at almost 4% a year. That's the highest level since 2009. You can see grocery store price has actually started backing off again. It was actually deflationary many years here, and then a gradual buildup, but has retrenched. And so in terms of the operator community and the ability and willingness of consumers to accept menu price inflation, it does become a serious consideration as to how to handle what goes on with menu pricing. Because in a typical restaurant, basically out of a typical sales dollar, roughly about a third is labor related, a third is food and beverage purchases, and the pre-tax profit margins for a typical operator are just 3 to 5% of sales. So when you have increased labor costs and increased food cost, it really does put pressures on those margins long term. Wholesale food price inflation, you can see is now running at 3%, the highest period since 2014. And the reason grocery store prices could drop in those periods was because food costs were actually deflating. So going forward, if you look at certain commodity groups, such as chicken and eggs, pork, fresh fruit, for example, a lot of those commodities are up by double digits this year. And so there's certain commodities which are down, for example, potatoes, but a lot depends on the menu theme. And that's why the ability to alter menus now digitally, online, and on tablets and on video menu boards becomes more important, because the industry is moving to a flexible pricing model in many instances. And the technology now allows that. It allows menu prices to literally be changed by time of day. And so for certain operators are already doing that, but it does indicate going towards the future that consumers are much more conscious of what's called yield management. In other words, the ability to change retail prices being dictated by the circumstances at a particular point in time. Another consideration in food prices, obviously, is the dramatic drought situation in the West. You can see it's extreme severe conditions in the West. If you look at what is going on with the La Nina setup for the upcoming winter, it indicates that this situation will only continue to grow worse. And obviously that puts huge pressure on commodity prices. And going forward, this situation is not expected to sizably improve into well 2022 now. So what actions did operators take during the pandemic to deal with these extremely trying circumstances? Well, streamlining menus was obviously one of them. And menu simplification, particularly for digital ordering, is very important. And it's also important how those menus appear in search engines and that the information be timely and correct. And so it's important to have staff that are dedicated to the maintenance of these online profiles for operations. Also, the emergence of what we call the streetery, the usage of, for example, sidewalks, parking lots, curb lanes for restaurant seating. It was quite popular with consumers, and the consumer research shows that they want it to continue. And in certain metropolitan areas, the regulators and legislators are working to extend it. Some communities, that's not happening. But the fact is, when you look at what the consumer wants, they like the availability of outdoor dining now. And a lot of these facilities that were built will still continue going forward. You can see from the, when we surveyed operators about were they offering outdoors, that the weather obviously impacts a sizable portion of the market. These are table service and this is quick service that offer. Once again, popular with consumers. All right, alcoholic beverages. Once again, it's a local and state decision. The research is quite clear. Consumers like to have the choice of having alcohol beverages delivered with their meals. And so certain communities are allowing this to stand in perpetuity. Some are still extending the timelines, and some have already said, no, they're not going to allow it to continue. But you have to look, when you look at millennials, it is a big decision point in their decision matrix as to how they choose were to order. Meals subscription programs, basically how consumers order and pay for their meals is changing dramatically. And if you look at subscription programs now, particularly for younger consumers, they were raised with subscription models, whereby you pay a certain amount per month, you get a certain bundle of goods or services, and then you can add on different incremental improvements to that package. But right now, there are operators, as part of their fundamental business plan, that offer subscription packages. Sometimes it's just for a beverage, sometimes it's just for a dessert or something. But going forward, this will become an important component of generating additional incremental revenue for restaurant operations. And it doesn't mean that every operator is going to offer a subscription package, but in certain circumstances, it can certainly make sense. In terms of technology integration, down here you'll notice 37% say there's not enough technology. And the industry, as we all know, is still a hospitality industry, but there is a lot of behind-the-scenes productivity and enhancements that can be made that facilitate that customer experience. And so if you look at this number right here, where do they want to see more technology? It's ordering and payment, service, off-premises, and making it faster. So it's pretty common sense as to where they're looking for that customer service experience to be improved. And when you look at technology used by consumers currently, it's pretty pedestrian. It isn't a lot of sophisticated stuff. They're just looking to view menus online, have the basics, locations, directions, hours of operation, and most importantly, having that accurate in real time. Because even though the industry is revitalizing, it is still an extremely competitive industry. And if that consumer has information they act upon which is not correct, they can be quite quick to vote with their feet. So it's once again important to maintain your digital imprint on an ongoing basis. Mobile payments. It's interesting. If you look at all restaurant orders pre-COVID, at that point in time, just about 5%, or 1 out of every restaurant orders was digital. If you look currently now, it's almost 1 out of 5, in other words, 20%. So that number of orders that were digital increased from 5% up to 20%. And so that once again has become an expectation to have a much easier ordering and payment system. And that's even true for the on-site portion as well. But if you look at the proportion that have used mobile payments in the past year, it obviously is higher in the under 40 crowd, but they are the future restaurant customers of tomorrow. Frequent diner programs, loyalty systems, once again a double-edged sword, but the technology integration has now allowed loyalty systems, and particularly for younger consumers, that ability to have and be rewarded in real time for their patronage is a basic expectation. And so now with the technology improvements, it is much easier to institute a loyalty program. But keep in mind that the industry compared to other industries is somewhat embryonic in this, and that the consumer, based on these other industry loyalty programs, have rewards which occur in real time. And so there's that immediate sense of gratification when they redeem whatever they're redeeming. If you ask operators the likelihood of keeping these changes, the yellow bars indicate the proportion that said they're going to keep some of them. The red bars are just 2 to 4% of operators say they weren't going to keep any of them. So the pandemic obviously transformed how the industry operates. Many of these trends were underlying pre-pandemic, but what the pandemic did was accelerate the integration and adaptation of many of these trends going forward. So to wrap up, we're all fortunate to be with an industry that the consumer wants to use. This is a very important criteria of this industry in that they want to spend money with us. And in terms of public perception, you can see even during the pandemic, we were number 3 in terms of positivity. And it's all food and then technology. In terms of looking ahead over the next decade, the association study that was recently completed, these were the 5 top things that are most likely to occur over the next decade, and this was actually concluded right before the pandemic. What constitutes a restaurant in America is rapidly changing. We now think of it more in terms of points of access, because with the advent of these virtual digital kitchens, it's a store which the public does not have access to. And the ability to decrease delivery times by putting in these new business models is definitely a long-term trend. It is not a fad. Off-premises will continue to grow. Convenience remains a very, very important driver. The margin pressures really only continue to be more intense. In terms of knowledge being king, data will provide that knowledge, but you have to have the systems in place to roll it up to get a true insight into what's happening in that specific operation. And the demographics of both the customers and our employees are continuing to change. In terms of the disruptors, and I think it's important to think of these disruptors as areas of opportunity and to a great degree, the intelligent restaurant, in other words, the use of artificial intelligence to predict demand, how demand will change, for example, when different weather situations occur. The ability to use the loyalty systems to predict ordering patterns. Virtual restaurants and cloud kitchens, in other words, the ability to really decrease the product delivery times to enhance product integrity. Also, apps. The technology integration really is threefold: front of the house, back of the house, and then the smartphone. And so the ability, either through your operation or through third-party providers, to have a robust app, particularly with the increase in digital ordering, becomes important. Autonomous vehicles in metropolitan areas, even before the pandemic, obviously, which you see here on the show floor, the ability of these robots to deliver the products with the integrity expected. And then finally, big tech bundling food. And this just really, if you think about it, is the embedding of advertising and ordering options in a lot of these online streaming services. So for individuals that are using these streaming services, there are now operators that are embedding the ability to promote and order in these services. Operators' outlook for general economic conditions in 6 months, you can see it peaked in the March, April. It's down to where it was about the beginning of the year. A lot of this is the realization that the stimulus effects are wearing off, and it's a much more moderate growth going forward once the effects of the pandemic are behind the country. In terms of macroeconomic indicators, real GDP up, rebounding. Income also grows, but is about half of what it was last year without the stimulus. Inflation's definitely taking hold, both nationally at the consumer level as well as in menu price inflation. And U.S. employment does regain some of the ground. Also, too, demographics has been and always is destiny for the restaurant industry. These are the state's annual population growth rates over a 10-year period. So if one is operating in the states that are in red, all those states in red over a 10-year period at this point are projected to have population growth of less than 1%. And nationally, if you look at national population growth rates, historically, they have now trended down. And in general, as a country, there's no substitute for sustained population growth rates. So this takes a while because it's baked in going forward. But once again, if you look at the green states, of which Texas is included, over the next decade it shows employment growth in excess of 10%. So demographically, those increases will drive income growth, which will drive restaurant spend growth. So to wrap up, this year obviously is a year of transition for the industry. The geographic variations are substantial. The macro trends, pandemic, economics, demographics, will continue to impact the industry over the longer term. Consumer pent-up demand remains solid. Greater emphasis on that off-premises market, obviously, and the addition of alcohol to that off-premises. Value-added products just means where the supplier community takes some of that labor off-site and moves it down the restaurant supply chain. And then finally, technology is a substantial productivity and efficiency enhancer for the industry. The consumer is quite comfortable with its integration as long as it doesn't detract from the quality of their experience, and does offer distinct competitive advantages going forward. So that concludes my presentation, and thank you.